Folks, if you can take your seat, we're going to get started, please. Good morning and welcome to NIpponnovation.com. Check, 1, 2, 3. Good morning, folks. Thank you for coming. My name is Dave McClure. I'm the founder and general partner, thank you, founder and general partner of Practical Venture Capital. I was also previously founder and general partner at 500 Startups. I've been coming to Japan for about 30 years, and I'm really happy to be back again. We're going to be talking about startups and venture capital, a US and Japan collaboration. So I hope throughout the day, if things get boring, you should go outside and chat with people and then get to know everybody else, but hopefully we will not be boring. I'm going to start off very briefly and talk a little bit about my experiences here in Japan, and then we'll have an opening keynote by video from Russell Cummer, who is the founder and chairman now of Paidy.com. That company was acquired by PayPal for about 2.7 billion about a year or two ago. Actually, I'm bragging, that was one of my best investments in Japan. All right, I'm going to sit down because my knees are not what they used to be. Hopefully you won't mind. And let's see if I can get the clicker working here. First of all, I'd like to thank all of our sponsors. That includes Jetro, 42 Geeks, Agility, Woven Capital, Practical Venture Capital, that's us, Benos, TS2, and I apologize if I'm not sure about all of the other names of our sponsors there, but they're all amazing and wonderful, and I hope to be drinking with you tonight. We're going to have 4 main sessions today with breaks in between, so we'll have about 3 talks this morning and then a break, and then another few talks. We'll have a lunch break, and then we'll have a few afternoon sessions as well with a break in between. I'm going to start off with a little bit about me and my love affair with Japan. So NIpponnovation, again, I hope the name of the conference is not too hokey, but we tried to come up with something that would actually combine innovation and Japan and also US. So that's a picture that sort of morphs together Mount Fuji and the Golden Gate Bridge. I don't know if you guys got that or not. Oh, sugoi. And I want to talk a little bit about 42 Geeks. Chok Oi, my partner in crime, where are you? Right there. So we have brought with us about 40, actually a little bit more than 42 geeks from New York, Silicon Valley, and all over the world. This is our 3rd country on our trip. We have been through Taiwan and Korea and now to Japan. We started doing 42 Geeks last year, and this is our 4th trip around the world. But actually, some of you may know I've previously been doing Geeks on a Plane for over 13 years. And our very first Geeks on a Plane trip back in 2009 or 10, I think, was also coming here to Japan. That's a picture of a bunch of geeks in a lobby of a hotel in Taipei. So this is a very thin font, but just a few notes about my love affair with Japan. So I've pretty much been a fan of Japan since I started watching Speed Racer. I was probably about 7 years old. That was back in the 70s. I was also a big fan of anime and animation. When Akira came out, I think in 88, I saw it in 89. And I pretty much watched every Hayao Miyazaki film ever made, at least I think so. I first visited Japan in 1994, and I've made over 50 trips in the last 30 years. I married a Japanese jazz pianist. You might have been hearing some music that was playing. That was actually my wife, Saya, and she got to play. She came to the US and was studying music in New Orleans with Ellis Marsalis. Some of you may know who that is. And she got to play with the backup keyboards for the Neville Brothers for a few years. She then came here to Japan and had a label deal with Pony Canyon between 2001 and 2006. I made my first VC investments in Japan in 2010. Matt Romaine was one of the co-founders of Gengo, which was acquired, and Paidy, which I just mentioned before. We'll hear from Russell in just a second. We also raised capital from a number of Japanese LPs and folks who helped with that, Joey Ito, George Kellerman, Shuji Honjo, and Ryota Matsuzaki. But we raised money from over at least 10, probably 10 or more Japanese LPs. We started a fund, 500 Startups in Japan, here in 2016. That was run by James Riney and Yohei Sawayama. They're now running Coral Capital. And we invested in over 60 companies in Japan. I'm also an LP in a Japanese VC fund. Shizen Capital is Matt Romaine's new VC fund. I have two other Japanese American startups which are very important to me. That's my son and daughter. Dante just started college this year. He's in Berlin for a few months before going to Boston to attend Northeastern. And my daughter Layla is a junior in high school. I'm such a believer in Japan that I bought property here twice, once in 2020 and again just this year. And we decided to bring this conference here to Japan to really open up Japan for some of our folks from the US who may not know about all the opportunities here, but we'll hear more about that opportunity throughout the day. And now the big plug. That is my most precious startup, or one of the two. That's a picture of my son from probably 17 years ago, I'm guessing. I actually had some hair then. And that's my wife, Saya. Layla was not born yet, but she'll be featured later. I bring up this picture just because we'll be hearing from Mark Suster later today, and he came with us on one of our very first Geeks on a Plane trips. Again, I think about 12 or 13 years ago. Sorry for the grainy photograph. That's him on the left. You might recognize the lady to my left in that photo to your right. My partner, Aman Verjee, is a big fan of Hillary Clinton, I hear. I did not have shoes on. I had flip-flops on. I cut them out of the picture. But I don't dress up for foreign dignitaries or even domestic dignitaries, I guess. All right, so we're going to jump into a little bit of a talk about Paidy. And Russell would have been here himself. However, he's currently supposed to be having a surprise birthday party in Dubai that his wife is throwing for him. I don't think it's a surprise anymore because he had to tell me about that in order to not show up. But we have a short video clip here that we'll play and hear a little bit from him.
Good morning. This is Dave McClure with Practical Venture Capital. You'll be seeing this here in Tokyo on the morning of October 12th. We're here at our NIpponnovation conference. That's a conference on US, Japan, venture capital, and startups. And I have with me our guest speaker and featured speaker, Russell Cummer, who is the founder and CEO, now chairman of Paidy. Paidy is a payments company that was acquired by PayPal, I believe, a year or two ago for about $2.7 billion. One of the largest, I think maybe the largest M&A transaction in Japan ever. And I was fortunate enough to be an early investor in the company. Russell, unfortunately, I guess, or fortunately, couldn't join us because he's about to have a birthday party, surprise birthday party, maybe not surprise anymore. Thrown by his wife in Dubai, but he's been kind enough to help us record a little bit of an interview that we'll be playing back in Tokyo. Russell, welcome.
Yeah, thank you, Dave. And as I said, hi everybody. I'm sorry not to be there, but I'm very excited that everyone is learning more about the startup ecosystem in Japan, and I hope you guys have a great conference. And yeah, apologies from my wife. I was planning to come, and she put her foot down and said, "You idiot! There are 8 friends coming from Tokyo out here to have a surprise birthday party for you, so you can't go." So I'm very sorry, but welcome and thank you for having me, Dave. And you know, I hope you guys will have a great event. So thank you.
Awesome. Sorry for spoiling your surprise birthday party. We'll try and keep this short. So I'd love to hear a little bit about the beginnings of Paidy and how you came to Japan. Maybe a little bit about the acquisition and or your decision, not to go to an IPO. And where things are at now, and then maybe some reflections on, the Japan startup opportunity, today versus maybe a decade ago. How did you decide to come to Japan, and why did you decide to start Paidy?
Yeah, thanks. So I actually have spent most of my life in Asia, and now Japan is actually the place where I lived the longest. So I was born in Singapore, and I grew up in Hong Kong. And actually, I started working after graduate school for Goldman Sachs in Japan. And I think maybe there's something that will resonate with some of the entrepreneurs in the audience. I mean, I really like that. And I like working with Goldman, lots of respect for the firm. And they ended up being an investor in Paidy and sort of helpful later on. But I also kind of knew that I really wanted to go out and try and do my own thing. That was going to be important for me on my kind of life journey. I wasn't sure if it would work or not, but I knew that I really kind of wanted to make a stab at it. And I had this observation at Goldman that basically financial services, were evolving in Japan, that actually it was a big market to serve. And that actually, unlike when I was in California, where it seemed like, every good idea had sort of 10 well-funded teams going after them, in the Japanese context, it felt like only 1 out of 10 opportunities had anybody trying to do anything. And of course, you say this is a long time ago, our shared joke is, Paidy is an overnight success that only took 13 years. But I left the firm and I got first into the money lending business in Japan. We were originally a peer-to-peer lending business, and we learned a lot. And I think honestly, a big part of that was we learned
unique there. I think I remember that you got a money license in Japan, which was very unusual, particularly for a foreigner.
For foreigners. Yes, that's right. Yeah. Look, I think Japan is a great place to build a business, right? It's, there's real rule of law. It doesn't matter if you're, there's no kind of idea of being better or worse connected. Everything is at your disposal. So yes, we were able to go out and get licensed. We were unique in that we were in a regulated space and, a team that was foreign. And this again was almost maybe 13 or 15 years ago now. But that was our experience. And then look, we did that business. We learned a lot about regulation, about risk, but we also learned about building consumer experiences. And actually the consumer experience of borrowing from us as a peer-to-peer lender wasn't differentiated enough to really scale. So as a team, again, as an entrepreneur, we kind of reduced the team. At one point we had maybe 12 people. We fired everybody down to 4. We were very lucky. We had investors like you and other people that kind of supported us through that pivot. And then we took all that we had learned and repurposed it into Paidy, which everybody now knows that, BNPL as a kind of category exists. And then we grew that into, kind of the largest BNPL service in Japan. We partnered with Apple, Amazon, basically kind of you name it in terms of international e-commerce guys and tons of local brands. And then of course it was purchased by PayPal, as you say, in the largest venture M&A transaction. I'm sure there are much bigger venture M&A, but, and look, for me, that journey was really interesting. There were learnings about how you as a founder have to grow. The business to some extent will be capped by whatever current state you're at. And I was very different as a 28-year-old founder leaving Goldman to start the company and being a 40-year-old founder selling it to a publicly listed company. And honestly, the growth through that dozen years with tremendous support from investors, from partners, from employees, like that growth opportunity, I'm also extremely grateful for. And I can see how at each stage of that journey, I replaced myself as the sole CEO. I hired a great partner, Fuku Sugie, and he and I still kind of run the business together, but that was graduation. My co-founder, who was great at the beginning, replaced himself as CTO. That was also very helpful because then when we were being acquired by a large public company, we had a CTO that could do that interface very well. So, that journey was really special. And I think Japan is a great place to do it in. The first 4 people at the company, the first 2 employees are still there. We've been on that whole journey together. I think that's very Japanese, right? People commit. There is this cliche that it's hard to get people to join a startup. I think that's falling away more and more. There are so many successes now with Parr and a bunch of others that people are excited to go on that journey. But I'll always be grateful to Japan for those opportunities and not only for kind of, the kind of the career aspect, but even this kind of personal growth around this journey of building a business and seeing it continue to grow. I don't know if that answers the question, but anyway.
That's great. I know we're skipping over a ton of time and a lot of ups and downs and journeys in the business, but after you sort of went to the buy now, pay later model, after you sort of had the relationships with Apple and Amazon, those I'm sure helped scale the company to a large, size. I know at one point you were thinking about maybe going public, and you decided to take an exit through acquisition. I guess I would say a very timely exit, probably.
Yeah.
Could you maybe talk a little bit about why you chose that route and what was going through your mind and sort of considering those exit opportunities?
Yeah. So I think, as a late stage, so there's all these aspects of being a founder, right? You have to, be the keeper of the vision. You have to, build the team and drive everybody, with that shared vision. You have to make sure you don't run out of money and die. But actually it's a little different later on, which is kind of, okay, well, sometimes there is this aspect where you're being true to the vision of what you build and how you service, customers and partners and whatever, that actually sometimes there's just a really natural home for the asset. And somehow, I feel, again, I don't want to speak in stereotypes, but there is this kind of stereotype that in a Japanese context, founders become obsessed with going public, or founders go public too early. And I think, again, those narratives are changing a little bit. There's a tremendous amount of capital available. People can try and scale businesses more before they list them. But, the listing becomes kind of a goal in and of itself. And that wasn't really the case for us, right? Capital structure was kind of subordinate to really this kind of mission and what was the right place to go and continue to execute. And in our space,
certainly large enough that you could have gone IPO, particularly even for the Japanese.
Without overshare. We ran a dual track process, which is kind of more custom in the elsewhere. But again, for all kinds of interesting reasons, it probably behooves founders to think about it that way, right? You're supposed to create optionality, all of that other good stuff. And for us, it was just very clear. PayPal is a very natural home. As you may recall, around exactly the same time, Afterpay was purchased by Square, which then became Block. So there was this kind of idea that, okay, access to larger balance sheet, although in a Japanese context, we had very good access to capital for running the business. But basically being part of a larger platform that could allow you to have relationships that are deeper with global merchants, the Shopify's, et cetera, of the world. I think that rationale was there. Very complementary fit in that Paidy is a very powerful domestic brand. I would say that. I'd like to think that, but obviously we continue to grow that brand. And hopefully the members of the audience will recognize Paidy. So for me, again, on this kind of personal, founder's journey, actually, I kind of understood that I was less, there wasn't this intrinsic drive to be I made it to IPO founder for my own motivation. It wasn't a motivating factor in any way. So then we could really look at it as what is the right outcome for investors, for the team, for the business, and really that for the asset going forward. Sorry, you want to say?
Yeah, and I think given the other transaction that was happening with Square, it seemed like there was activity in the market where there was an opportunity that presented itself, and maybe that was a good time. A lot of entrepreneurs don't take advantage of the right market timing. It seems like you guys did.
Yeah, well, I joke, but it's true. It's always better to be lucky than good. So we were lucky. Yeah, it's kind of easy. But that said, look, I think we built a really robust business that honestly has continued to grow tremendously post-acquisition, leveraging all of what we wanted to get from having a bigger balance sheet and having a parent. The single shareholder structure is very different than having to balance maybe different priorities amongst a more diverse, group of shareholders. So yeah, we're very pleased, and I'm very pleased that you were part of that journey, Dave.
I believe the other thing, humble brag comment I'm supposed to say here was glad to be a small part of your big.
But it is, to everybody, and it is a journey. People should embrace it. I think that I want to be the one founder that kind of speaks founder. This, you're gonna grow from this. You're gonna be challenged.
Put a pin in that for a second. Now let's talk maybe about your perspectives on the current Japanese market opportunity for startups, and how is that different, better, worse today than maybe 10, 13, 15 years ago? And do you think it's a good opportunity for startups in Japan today?
Yeah, I do. Yeah, I do. I absolutely do. So I think the answer to this can be very succinct. Look, 15 years ago, not very much sort of high quality investor base, which I do think has gotten much better. And I think there is a view globally, not just for Japan, but for a bunch of different geographies where, you know, I think if you are starting a business in Japan and it's fairly well understood, then basically like country risk of Japan, I think everybody views it as a very safe jurisdiction. You can have exits, you can have listings, you can, you know, all of this, that, and the other. Regulation is good, all of that stuff. You know, if it's a business model that's kind of been de-risked or proven elsewhere, so let's say BNPL or, you know, whatever P2B, you know, person-to-person shopping like the carousels or the McClures or whatever, that's okay. Then all that's left is really this like execution risk around the team. Are they going to manage it well? Are they going to do the right things? All of that's very important. Sorry, somebody is cleaning something with me here. I hope it's not too loud. So I think that there are more and more people, you know, the story of Paidy was basically funding onshore, funding offshore, funding onshore, funding offshore. You know, we raised more than $300 million through A to D. And it almost sort of was really this back and forth. And the offshore people, there are people that are very expert at, let's say, fintech or ad tech or insurtech or biotech. And actually, those people are not limiting themselves. You know, this old paradigm of, okay, if you're not, you know, 10 minutes from Sandhill Road, I don't think that's true anymore. And I think that good teams executing on good strategies in Japan really can take advantage of that. I think that there are people that are looking to do that, right? I mean, again, there's various different, you know, obviously there's your conference, there's all sorts of different people that are, you know, that are looking at Japan. And I think the talent base there is good. And really this talent on the investor side, I don't want to praise investors too much, but, you know, in my journey, like having access to people that have been early investors in comparable businesses and could give guidance about how you scale, let's say, a balance sheet or a book of risk or even other things, whatever, like branding, partner, like that was very, very helpful. And I think that is available to Japanese founders now if they're able to take advantage of it, which is great. That's good for the ecosystem. It's good for everybody.
Well, I appreciate you kind of giving us some time away from your birthday party. I know we're going to be hearing a lot of stories today about different programs and initiatives that are being put on by the Japanese government, both for investors and for entrepreneurs, and also for foreign investors in Japan as well, which I know is a big part of the push and hopefully of interest to some of our attendees here today. Russell, thanks for making time for us. And
my pleasure. All right.
Congrats again on a great outcome, and I hope that you'll put some of that money back into Japanese startups and maybe other funds that are investing there too.
We'll do our best. Thanks, Dave. Thanks, everybody. Good luck, and thanks again for having me. Thank you.
Bye. Thanks.
Sorry, the audio quality wasn't amazing there, but hopefully we got a little bit of the flavor. One thing I did want to point out, I know we're highlighting a gaijin's business who was successful in Japan. I did that because I kind of feel like that's harder. And actually, there's plenty of other examples of domestic Japan entrepreneurs being quite successful. Mikitani-san at Rakuten, Taizo will be with us later today, Taizo Son and his brother Masayoshi-san at SoftBank. But I think it's particularly interesting that, you know, a company that was started by a foreigner also had a big outcome. And actually, me as a gaijin investor in Japan had a pretty much 100x outcome on our investment there. So it's not impossible for other people to access the Japanese market. It's the third largest economy in the world. I would actually say there's less competition here than maybe other places in the world, and the opportunity is still tremendous, both as an entrepreneur and an investor in Japan. We're going to move on to our next speaker and hear from Mark Suster. Mark is a good friend of mine from way back. He's been incredibly successful with his own, at first, startup company, which was acquired, but then also with Upfront Ventures, and we'll hear from him coming up now. Thanks for your time.
How about that? Did you turn the mic off before you handed it to me? I literally touched nothing. Konnichiwa. It's good to see everybody. As I was saying, I've been friends with Dave for 20 years, almost, before either of us were really doing venture capital. I want to also applaud Dave because he really was the earliest champion. Hey, Eric. He was the earliest champion of international investing, international markets, highlighting the innovation happening all over the world. And the reason that spoke to me so much is I actually lived internationally for 11 years, including in Japan in 1999. So what I want to talk about today is venture capital for the next decade. What do I believe will happen? So first of all, why should venture exist? I guess in this group, it shouldn't go without saying that it should exist, but let's justify it a little bit. What I have on this chart is global demographics excluding the United States. And what you see on the right-hand side is men, on the left-hand side is women. And what you see towards the top, the further up the top is the older the band of people who were born in that time frame, and the bottom is the younger people. And this illustrates very clearly that we have a demographic problem if we want to keep GDP increasing and increase resources for everybody in the world. We need productivity gains. If you include the United States is a little bit different, but not so different. We have a flattening demographic trend that's reversing the last 100+ years of demographic growth. And so I start with one statement, which is, again, this is just the United States, but the trends are pretty similar in many places. In the United States, we have 3.8% unemployment. That's what economists call full employment. It's a problem, and that problem manifests itself in increasing wages and inflation. There's only one of the reasons you see inflation today. But without more workers, if we want to keep GDP growing, that necessitates robotics. It necessitates AI. It necessitates automation. This is justification number one. Justification number two, I wrote this slide about a year ago for my own LPs, but never is it more true than this week. The world is deglobalizing. World War II, post-World War II, defense structures of how countries resolve differences, those norms are reversing. And that is leading to pressure on technologies like cybersecurity, national defense, the need to increase agricultural production. If you just look at Ukraine, taking Ukraine grain out of the world, you may not feel in Japan, we may not feel in the United States, but believe me, many places around the world are going to notice not just less wheat, but with less petroleum, it means less fertilizer. With less fertilizer, it means growing less crops. Growing less crops means more people die. This is the world that we face. I think obvious that climate change is a major problem that the world is trying to address. In my neighborhood in Los Angeles, that manifests itself as regular fires. So we've been looking at and investing in technology that can actually reduce the spread of fires. Obviously, many companies now are looking at carbon reduction as a way of changing climate change. Also, this deglobalization and goal of reducing carbon footprints is creating more regional supply chains. So all of these solutions are needed to protect assets and to protect people. This isn't probably what you're used to when people are talking about technology, but if you're going to invest in technology, you really need to understand the macro trends that are driving your technology. We seem to exist in a little bubble where we read our own articles, we talk about our own technologies, we think that what we do is the only important stuff. And in reality, we are in service of something much bigger. National budgets are under pressure. across the world. We've had for too long people using debt to finance governments. We have not just declining birth rates, but people living longer, so aging population. And I mentioned the obvious, which is technology must be a solution for providing healthcare going forward. Aging population, and that also means a reduction of number of medical professionals everywhere. So with that as the backdrop, I want to talk a little bit about venture capital. I want to talk about where we as Upfront Ventures, my fund is focused, and how those macro trends affect us. So to be good at venture capital, you really need to do three things right. And they sound relatively easy, but they're actually quite hard. The first is you actually shouldn't have to be said, but you kind of need to know something about technology. And we do get many people who enter our industry that actually don't. Fundamentally, if you start to grow a business and you want that business to have more than linear scale and to protect itself from competition, technology must be at the heart of defensibility. We simply won't fund companies that don't at their core have technology as the most defensible part of what they do. So you have to know something about tech, but that's not enough. You also need to understand the timing of technology. If you invest in a trend that is coming in 10 years, you're not going to do well as a venture capitalist. There's an old saying in technology, which is that being too early is the same as being wrong. Being too early is the same as being wrong. If you piled your money into this thing called AR and VR in 2017, you lost a metric shit ton of money. And a lot of people were doing that. The trend is right. The timing was wrong. If you are investing in what you're reading about in the media today, and you're starting today, you missed it. Move on to the next thing. How many people were sitting at a poker table at 1 a.m. and people shouted crypto and they said, "I'm all in"? How did that work out for 2020? If you were investing in 2013, 14, 15, like Fred Wilson and Chris Dixon and a lot of the people who were betting on the trend, and the trend might have been right, it might have been wrong, but they made a lot of money. Pushing in your chips on today's technology is a recipe for losing money. And here's the really big kicker. You can be right about the trend. You can be right about the timing. But venture capital is a winner take most business. And if you bet on the wrong team, you also lose. I bet on a text messaging platform. I lived in Europe. I saw text messaging emerging. I lived in Japan in 1999. I watched devices as small as this at NTT Docomo and people like doing this. And then I go back to the US and nobody's sending text messaging. I said, this is it. This is the next big trend. The problem is, and I invested in a very fast growing business. The problem is, it wasn't called WhatsApp. So venture capitalists, I like to say that our industry operates like children on a soccer field. Everybody chases the ball. Nobody stays in position. So right now, everybody's investing in what? Just tell them. Generative AI. Can't just be AI. What the? Can someone tell me what that says, or should I get on my phone? And okay. Yeah. Generative AI is okay. The majority of money is made by staying in position. Ignore the people telling you to join the latest trend. It is really hard to be a VC because you need to raise money from LPs. And LPs read papers too. And they tell you, how many generative AI companies do you have? How many unicorn companies do you have? How many crypto? And it's really hard to bet against that trend. So we have just finished the longest bull market in the technology history, 13 unabated years. And what that means is two things. One is people like who entered the market in the last 13 years have learned that things just go up and to the right. In order to have seen one major correction, the GFC, the global financial crisis, in order to have seen one, you have to be in your 40s. In order to have seen the dot-com bust and the GFC, you have to be in your 50s. And I'm not saying that old guys rule, but I'm not saying that. It's very clear to me to be in a VC fund, you need young people, because the young people who work in my office, they know the next technology trends. They're in all the wedding parties. They're going to birthday parties in Dubai. They're with the people creating companies, but that mixture between experience to not chase trends and youth and energy and vision, that's a really important mix. Seed stages got a little bit crazy. We had a 100x increase since people like Dave McClure pioneered this category. What is even crazier is how much money was given to the largest venture capital funds. And by the way, I'm happy to publish these slides. I'll send them to Dave if you don't want to take pictures, but you're also welcome. They look much nicer because I'm in front of them. No. So these are the 10 biggest venture funds in the United States. They raised in the last 4 years 4 times more than they raised in the prior 3 years per year. They raised $4.5 billion per year more than the prior 3 years. What problem did that create? It drove up valuations to unsustainable levels because you had an increase in supply and not an increase in amazing outcomes. And ultimately, it created this trend. Okay, so this is plotting so-called unicorns. I'd like you to look at the left side of that chart. It starts in 2012. There was an article written in 2013 by Aileen Lee. There were 3 companies in that year. This is new per year, not cumulative number of unicorns. And in 2013, looking one bar chart to the left, she said, there's not many billion-dollar outcomes. They're unicorns. And then suddenly, all of a sudden, we started creating all of these companies valued at $1 billion. Not worth, but valued. And it culminated in 2021 with 723 of them. But I would ask you to look at this chart. This is the number of public companies in the United States worth $1 billion or more, publicly traded. There are exactly 343 of them. That's it. And yet we created 723 in 1 year. There are 1,400 approximately private billion-dollar valued companies, of which I predict 1,100 will never be worth $1 billion when they exit. So finally, the public markets did what they do. They reverted to the mean. Valuation multiples declined. If you look at the top, these are 4 different markets, 24.6. What does that mean? That means that November 9th, 2021, public markets were paying 24.6 times next year's revenue. Guess what the 20-year average is? So it's 24.6 was the peak, 6.2. That's public markets. Private markets were even crazier. So this is private markets, Series C and Series D. In 2022, we started the year 500 million post. We ended the year at 187 post as the median valuation. So valuations have started to correct. But there are 5,000 seed A and B companies created per year in the last 4 years. Those 20,000 companies are running into a phenomenon called a brick wall. There just is not that much financing for them. So some VCs, seeing this overvaluation, will simply wait for the next cohort of startups to come along, which is why it's a great time to be starting a company, because those companies don't have all the problems that came before. So what are 3 strategies we're pursuing it up front? And sorry for going fast. I just don't want to overrun for Dave. We try to be a few years ahead of where we think most of the market is. And starting from the top to the bottom are some trends we started investing in. So in 2017, we started investing more in healthcare and biology. It was really a recognition that this thing called AI is real. And it's not that we don't believe it. We have, I don't know, 8 or 10 AI companies, all of which are now suddenly getting increasingly valued by people. We just think that AI, it's like a decade ago when people were creating mobile funds. Of course, mobile is everything. AI is everything. Can you imagine going to a doctor in 10 years from now and them not consulting AI models to look at your data? Can you imagine people trying to fix your car with not addressing it? You know, whatever you're thinking about the future, talking to a customer service rep where they're not using AI or chatbots to talk with you. So increasingly now, though, our biggest theme is space and national defense. So I want to talk about these two areas first. One is healthcare. And what you see on this slide is the shortage of physicians in the United States. Tens of thousands of unfilled jobs because we simply don't have the training or the people or the demographics. And we have decided that we no longer believe in immigration. We can't go to the Philippines. We can't go to Nigeria. We can't ask more people to move from Mexico to try and fill this problem. It's not going to happen. Politics won't allow it. And this is true globally. But to be a good investor, I also believe you need edge. You need to be good at something that other people aren't, not just the trend, but you need something else. At upfront, our something else is Los Angeles. So we invest about 40% of our dollars in LA. Less than half. We're not regional, but that serves as edge. So if you look at healthcare, this is the number of top life sciences jobs and top 100 hospitals in the country based in Los Angeles. It is the leading market in the United States for healthcare. If you look at defense, this is the expenditures on space. The left-hand part of the chart, it's about $500 billion expenditure today, expected to grow by 3x. But what you might find interesting about space is if you look at the right-hand side, 77% of that entire economy is commercial, not governmental. So government's important, but people assume that space is only government. It's actually quite an incredible commercial opportunity. So let me make this argument for why Dave McClure was successful. I would argue he's partially charming, but on the left-hand side, this drove his success is AWS. Because AWS drove down the costs of compute, of launching a startup by 90% between 2000 and 2005, and another 90% by 2010. That allowed 500 startups to be funded because you could hand people $500,000 instead of $5 million. And you saw a Cambrian explosion of startup companies. The same thing is happening in space. On the right-hand side is the cost per kilogram to launch into space. It's already come down by 90%. Why? SpaceX. Because of Falcon 9, you can take the base of the rocket, launch it into space, and re-land it. And as a result, the cost of relaunching and relaunching and relaunching has gone down tremendously. SpaceX has a near monopoly today, but there are other companies like Stoke and other companies now who are forming to try and compete. Eventually, I think some will catch them. But even if it's just SpaceX, the cost has come down tremendously, which is why in Los Angeles, there are 91 startups that have spun out of SpaceX. So Elon decided to move to Texas. Texas has no taxes, state taxes. That may have been a decision, part of his decision, but there's a lot of people who didn't want to go. So this is part now of the important economy of Los Angeles. So if you look at it, 40% now of all funding into aerospace, defense, and space startups now is in Southern California. Last point, we are also focused on secondary markets. And I wanted to make this small plug because that's Dave's focus, but it also is a major focus for us. So on the right-hand side, you see our last round valuation of a mythical company. Call it any company. If you move a little bit to the left, you will see the value today. It's about 20% down. What does this mean? Let me just explain it for a second. When venture capitalists invested in a company, let's say they set the value at $1 billion. Right now on their books, they've probably marked it down to 850 or 800. because they look at the public markets are down, and so they mark it down. So this is the nominal valuation that a venture capital fund holds it on their books. All the way on the left is something called the 409A valuation. In the United States, that's the price at which employees buy their stock options if they execute. So employees aren't going to sell you stock cheaper than they have to pay, but they are willing to sell it for something cheaper than the venture capitalists are holding preferred stock. So why do we think this is a really interesting opportunity? Well, angel and seed funds need liquidity. Number two is the liquidity that they thought was right around the corner in 2021 suddenly has been pushed out to 2025. Now, they don't want to sell everything, but if they could sell 20%, 25%, and be 75% long, they could return money to investors and then go out and use that as a way to encourage people to invest in their next fund. So this is happening everywhere now. Third point, management teams. Let's say you've been at a company for 8 years, 10 years. Let's say that you have 3 kids in high school. You're starting to think about how you're going to send them to college. You've been telling your husband, you've been telling your wife, don't worry, I know I don't make as much as I should be making, but we're about to get all this money in stock options. And then suddenly you say, maybe by the time they're done with college. If you could sell 20% today and fund their college education or buy a house or take the pressure off the home front, would you sell 20%? My conversations say yes. And finally, LPs have a problem. And this is called the denominator problem, because they have too much as a percentage of the pie allocated to venture capital right now. And they need to get that down, which is forcing people to start considering selling part of their positions early to generate liquidity. I think it's one of the best trades in venture capital right now. That's it on why we are long on the technology markets. We think it's important for society. We are equally long. I want to close this on the US-Japanese alliance. Why? Because decoupling China from the US, which is going to happen whether we like it or not, I don't think it's good for the world, but it is what's happening. I think we'll put more pressure on the US-Japanese, US-Korean, US-Taiwanese relationship. We have so much vested interest in getting the combined cross-border opportunities working. It works with Israel in the United States. It's a tiny country, 7-ish million people, 120 million people in Japan. It should be 10 to 20 times the opportunity. Thank you.
Check. Thanks, Mark. That was also a great plug for the countries which we've just been visiting, which included Taiwan, Korea, and Japan. So we're going to take a little bit of time to maybe cover a few things that were in your slides. I guess I'm happy that you highlighted healthcare and space as 2 big areas of investment, but selfishly, I kind of want to talk a little bit about the secondary opportunity that you were highlighting there. I guess maybe a big picture story. What's new and different about secondaries, or is anything new and different, and why is now maybe an interesting time?
So secondaries have always existed. It's always been a very big market, but secondaries historically have focused on buyout funds or private equity. It was always seen that if you were in venture capital, you shouldn't sell early. And it really never made sense to me. Like, if you get into an interesting company, I don't think that means that you need to sell everything. But again, I just want to use a poker analogy or a blackjack or whatever. I guess it's more poker, let's say. You know, if you're sitting at a table and you suddenly find that you've got this massive pile of winnings in front of you, why not take 20% off and put it in your pocket to make sure that if you start to lose some money, you at least are going to go home with gains? And venture capitalists never thought about that. But keep this in mind is 10 years ago, the average great company at a venture capital firm IPO'd within 6 to 8 years. Today, even excluding the fact that the IPO window has gone away, it was more like 12 to 13 years. So just doubling the time to get liquidity creates a huge problem for limited partners, which is lack of liquidity. And yet we have founders who regularly sell a little bit of their stake at year 3, 4, and 5. Why do founders sell? one of the reasons founders sell is they're like, hey, I want to de-risk and take some cash off the table while still remaining long. And then we have aligned incentives and I can focus. And, frankly, then my husband, wife, partner, whatever isn't going to bug me as much, but it's the same exact trade. So I think the lack of DPI is starting to become something that LPs are aware of and therefore VCs are aware of. And I just want to say this real quickly, Dave, in defense of secondary and why I think it's so interesting is if you look at the 20-year average in venture capital, DPI, distributions per invested capital.
Cash back to LPs.
Cash back to LPs for top quartile funds is 2.5 to 3 times a fund, 2.5 to 3x. That's top quartile. You have a number of early stage funds holding their funds at 7-8x TVPI, which is paper gain, not cash gain, with no DPI. And this 7-8x holding value is going to collapse. But that's exactly what happened in the last 2 market corrections. And again, I think this need for cash distributions for LPs and for VCs is driving people to reconsider early exits.
Yeah, and I'll reflect just personally when you were talking up there about selling 20% and paying for a house and paying for college. That was exactly my scenario. 3 years ago, I had some pretty significant paper gains from carry in our first 2 funds at 500 startups and decided to take some money off the table. Was able to buy a house in Los Altos, California, which was not cheap. Put some money into our new firm and put some money away for college for the kids. At the time, I was worried. I sold at effectively about a 30% discount to NAV, and that was in a good market 3 years ago. And I thought, geez, I'm selling, something that probably is going to end up making 2 to 3x for the people that bought it from me. But the portion that I'm not selling, if that happens, will be quite considerable. And heaven forbid, if something happens negatively in the market, at least I'll have taken some money off the table. And I think that math is probably a lot more present now for people in a tough market. And obviously prices have come down a little bit. I think one other note I would bring up is you and I had a conversation last summer about the secondary topic. And I think we were both surprised to hear that we were each thinking about that. It wasn't really on very many people's radar at the time. And in fact, everybody was still kind of recovering from the market collapse, but it seems like there's a pretty big opportunity now.
So one thing I would point out is when you invest in venture capital fund, which I think is a good idea, since I raised money.
For the top quartile funds, which we both are.
Well, I just
top decile.
I just meant good idea because why would I say it's a bad idea since I raised money? But it is what's called a blind pool, meaning you give us money and you have absolutely no idea what we're going to do with it. And we have a track record that says for every 40 investments we do about 40 investments per fund, 6 of them drive 80% of returns. So it operates as, something called the power law. But with secondary, if you invest in secondary, you actually know the underlying assets you're investing in and you're buying them at a discount. So we exit about $80 to $100 million a year consistently for the last, call it 20 years. Most of our funds are small, between 2 to 300 million. So, we're regularly ringing the cash register. In 2021 alone, we exited almost $600 million in 1 year. Why? Because the markets were crazy. And so we sold 165 in one secondary transaction at a 16.8% discount to my holding. Today, if you're a buyer, the minimum discount is 40%.
That would be minimum, and I think we're typically seeing 50 to 70% in a lot of scenarios.
So it's a good buying opportunity if you can find supply.
Yeah, and I think your other comment before about, historically private equity and buyout has kind of been where the secondary market's been more active. That maybe started 20, 25 years ago. I think it's $150 billion in traded secondary in the private equity market. Comparatively on venture, stats are a little fuzzy, but probably closer to maybe only 50 billion right now. Most of that is actually direct secondary in companies. Hardly any of that, at least to date, has been in funds. Any comments on what you think about direct versus portfolio secondary?
I think they're both interesting opportunities. Venture capitalists need to be educated, and they need to be educated that this exists and why is it a good thing to do. The good news is I think LPs are starting to educate them, saying, we're not writing a check unless you send us cash. And it's hard to generate cash because you can't go to your CEOs and say, sell your company, please. And so one way that they can do it is by selling part of their funds. So I think it's naturally going to happen, but I'm out for educating the market. We've talked a lot about why we did it in 2021. There are some complexities. If you do a lot of secondary in the United States, at least, you have to be registered with the SEC. It's not a terrible thing to be registered with the SEC, but we are registered with the SEC, both because we were a large seller and a large buyer of secondary markets.
I think in the US, it's somewhere between 110, 150 million under management that you have to become.
I don't remember the bright line test, but I know that if you're doing it substantively, you have to be registered. But I think you're going to see a lot more of it. Now, for me personally, as a VC, like if I was in your position, I think what an amazing thing to buy out a bunch of VC managers, both because you can buy 15 or 20 companies at once or more. But also imagine you look at 200 VC funds and you only do 5. Well, you have all the data now on all the underlying portfolio companies. It's the best information arbitrage trade deal I could think of. But I don't suggest doing it. But on top of that, I think it's a great way to build diversity in the portfolio of diversity of companies. Now, for me as a venture capitalist, I don't have the time to do that. What I'm doing is targeting companies I already know and individual shareholders that I know need liquidity. And the first trade I'm trying to do, I told you last night, I've generated about $75 million of interest across 3 companies that I'm targeting of people who want to sell. And then I've talked to a couple of very large funds that want to do secondary, and I'm trying to create a vehicle to broker that transaction.
I have a million more questions I'd love to ask you. We're running a little bit behind on our talk today, but thanks again for coming and talking about what you're heading towards in the next few years, and I think also highlighting the Japan-US alliance. Thanks, Mark.
Thanks for having me.
Our next speaker is going to be Arnaud Bonzom. We're running a little bit behind on schedule. That's okay. We built in a little bit of cushion today, but we'll try and catch up as we get a little closer to break. Arnaud, welcome on stage.
Yeah. So now we'll talk a little bit more about governments and how they play such an active role in startup ecosystems. So every startup ecosystem have bottlenecks and all of them struggle at different things, but we can see a lot of bottlenecks that are similar across many ecosystems. So one of them is talent, right? So that have been covered a little bit today. But for example, this is one way to solve it from the Malaysian government. They're offering visa for entrepreneurs. We're going to talk a little bit later about that one, but they're quite generous compared to other governments. Lack of capital, that is often a big challenge. And you can see, for example, sometimes government also being involved doing fund of funds to nurture more VC fund at the early days. We can see a lot of liquidity issues, so that have been covered already a little bit today, and we're going to cover that also as well. So public market is one way, but we're also going to talk about secondaries. Education could be also quite a big of challenge, especially when you're in a very early stage ecosystem. So that was another program by Malaysian government with Stanford. So we're going to also talk a little bit about Stanford today and some other schools. Size of market could be a big challenge. So if you're US or Japan, it's not so much a big problem. But if you come from Southeast Asia or from Israel, you have a big challenge there. Beachhead is a program done by the New Zealand government about how do you give a board of advisors for half a day from experts from that local market to help those entrepreneurs to understand the market before they enter that place. Branding is also something quite important, and there's some ecosystems that are having very good branding and some other not very good. We're going to talk a little bit more about what France did in that sense with something called French Tech to promote that ecosystem across the world. And another point is a lack of density. So is what I think Mark also discussed of density in Los Angeles on space or on biotech. So that is something very interesting too. And some government are also working in that space. So we're going to describe a bit more what Singaporean government is doing with Block 71 and across several other buildings. So a big question, and what Mark covers a lot on the VC, is the timing, is the why now, which is also a question asked very often by that tiny investors that you may heard of that have been playing that game for the last 50 years. Government play in a very different time horizon. They should come when it's too early for the VCs. They should come before. They should take that risk because they also play the game on a longer time frame, not just for them to be reelected, which some of them could be 3, 4, 5, or 7 years, but they're here for a longer period of time, where VCs usually is 10 years, so the timing is way more important for them. So we're going to look a little bit more at some governments and some of the history and what they have done. So if we go back to history of US, some people may start that with PayPal mafia, and I know some people here are being involved with PayPal in different ways, but we can dig even if deeper. So some of you will know about the Fairchild mafia and those 8 people who have very massive impact. Huh? Yeah, they're traders at that point. It's true. But we can even if that is mostly like the West Coast, right? But then you have also this man. I don't know if anyone recognize him. We're digging into a little bit less well-known people here. So that is East Coast. He was one of the most admired professor in Harvard University. He also ended up to be considered as the godfather of the VC industry. And he did one of his first investment in 57 with the American Research and Development Corporation, and he got a massive home run with that deal. He also ended up to be the co-founder of INSEAD, the business school. So interestingly, as we see now, we already start to have a lot of involvement with different schools. And another one that have a very active role in the US have been Stanford, and I think Alan is not going to go against that point, right? Is carrying on the cap today. But also the army. And so that is something you can see across different ecosystems. For example, Israel, of course, but the US, the army play a lot of support to the ecosystem through the Cold War, through the World War II. George Doyo was also involved with the army. So you get a lot of that aspect too there. Another man that being very involved and also be considered as a godfather of Silicon Valley is Frederick Terman. So as we see so far, a lot of men. Unfortunately, we don't have that much women involved at that stage. Well, I'm going to share a few more later on. But you get a lot of university, a lot of governments, and things also take a very long time. Because here we're talking about things that started like 70 or 80 years ago. So it's very unfair to compare a lot of startup ecosystem to the US, because you are comparing like a child to a teenager in the best case, or if not a young adult. So it's a massive gap anyway, and there's a lot of things you cannot compress. You cannot build a unicorn company in like 5 years. That is really an exception. It's take more like an overnight success in 10 years, as we hear often. So Israel is a very interesting ecosystem because compared to US, they have way less assets to start with in terms of size, in terms of languages. But if we look at the 7 challenge we mentioned before, they find different way to look after it and a way to that help the startup ecosystem there. So for talents, they have an ability to get any Jewish people to move to Israel if they wish. So that is kind of a large pool of talents. The downside of that is that makes real estate very expensive in Israel. And that is a big challenge for a lot of people there. For capital, they initially have a lot of lack of capital, but they have an initiative called Yozma where they're doing matchmaking. So they end up to the government to support a lot of VCs. And then now you get a lot of US VCs also being based in Israel. So access to capital is not so much an issue these days, but when you look at the size of the country and the size of the market, it looks like an impossible thing to solve at the beginning. So when you look at Japan, is way more capital here than what you get there at the beginning. Liquidity is a big issue there, especially when you're in a small market. So the advantage of Israel is 2 things. One is a lot of R&D center for all those large corporations. So it's like several hundred of them, which really help when you do an acquisition to integrate those company with your HQ through the R&D center. So it's a lot of M&A. That is a bit of drawback in that ecosystem. There's no much local giant being built. Is everything being sold and value being captured mostly by US companies. So if you look at Waze, for example, or other technologies, at the end of the day, the US will own it. And I'll look at things like YouTube and Google. There's way more value created after acquisition than before. So that is a challenge also for Israel. They don't capture as much as value, but they still create a lot. Education is also a big thing, and that is very interesting. You will hear a lot about the army. You will hear a lot about the unit 8,200. Interestingly, one of the big challenges of Israel is the size of the population. It's such a tiny country that when they have to allocate every talent, and I literally say every because there are men and women go to the army, they have to match make them to the right team. And then they're going for the men to work together for 3 years, the women 2 years. So they have like very tight team, and they spend a lot of time together, but government cannot fuck up that matchmaking because they have so little amount of talent available. So that create like very deep connection. And when you ask around, if you know people who are helicopter pilot, they know the other guys. They know each other. It's like very, very tiny community there. For the lack of market, you will see Israel almost from day one is US market or built globally. So that is very interesting that they do that because in a way they don't have to ask themselves the question. I see that happen in a lot of mid-sized market. For example, France, people think it's big enough, but that is very dangerous because it's not big enough. It's too small. So you need quickly to be European or look at US or global. And the one who do that quite well is Indian companies. They do quite often go global or US for the SaaS companies. So that is something people need to be careful about size of markets, but Israel find their way there. Branding, I think until you get Startup Nation, people didn't know much, but then now I think there's no much to talk about it. Density is almost everything happen in Tel Aviv. There's no much other options. So that is not much an issue there. So interestingly, that has also helped a lot the Israel startup ecosystem to get visibility. Was a Startup Nation. Interestingly, it became also Startup Nation Central, which is more like an association that provide a lot of support for the ecosystem. So they provide, for example, a lot of resources for free, including a massive database of VCs and startups. So that brings a lot of clarity to navigate the ecosystem. We're going to discuss that a little bit later, but that is one big challenge is a lot of those startup ecosystem are very opaque. They move very fast. So you need ways to explain to people how that work and how to discover it. So 42 gigs is great, but it's only 42 people at a time. So even if you do 4 trips a year, we need also other scalable way to do it. And then you get that organization that have been studied again 60 years ago is Israel Innovation Authority, which is an independent organization that do a lot of policies and support for the ecosystem. So that is very interesting. It's not the government directly. They have kind of an NGO between to do those kind of thing and support it. So they have been doing a lot of great thing, and is why Singapore, for example, inspired themselves a lot through Israel, and a lot of other governments look after Israel as a way to learn about it. So France, as you guessed by now, I'm originally from France. I don't know if you recognize any of those companies here. So at least one, which I'm pretty sure you didn't know was French, is the second one, VLC. So that is a French company. So before streaming, you may have used it a lot for your video. But the Minitel was kind of the beginning of the internet in France. If you check your credit cards on the back, you will only see 2 companies. One is called Gemalto. And if you don't have Gemalto, quite often you will get Oberture. Those 2 companies are French, but terrible at marketing. So you get great engineers in France. You will see a lot of them these days in AI and Gen AI. Jan Luken, that you may have heard of at Facebook, is French. But marketing, French are very bad. We need the American to do that for us. Ubisoft is a gaming. Here is Assassin's Creed. So we do a lot also in a gaming space. But branding, very bad. Very, very bad. And then we had that initiative called French Tech, and where they decided to brand in a better way the ecosystem across the world, and they wanted to get that known. So they get this small roster, and they get it as a red one. The blue one is more for hardware, and they have a few other way to look at it. But the idea was also quite interesting, is branding and community. So if you come in almost all the main startup ecosystem, you can get a WhatsApp group or Slack group where the language will be English and not French, and where they will gather most of the French community and some other people who want to join. So it's open to everyone. And that is something that the French government have been supporting through grants and other initiatives. This is something very interesting that France is doing now for a few years, where they showcase the top 40 and top 120 startup of the local ecosystem, which give a lot of visibility to them. Of course, such things we can always discuss the methodology and which have been selected and which one haven't been selected, but at least it bring more visibility to the ecosystem and it make it easier for people to navigate it. The French government, through their sovereign wealth fund, BPI France, they also bring sometimes some US top VC to come to France and explore the ecosystem. So they do such initiative to make those connections. So now, thanks to that, here you can have like 4 companies that are being showcased. I guess at least you recognize one soccer player, maybe not the company behind it. But here is like some companies that are French, and Sora is more about the new Panini, if you know. And here I just picked those 4 kind of randomly, but interestingly, all of them have the same investor. It's Xavier Niel. We're going to talk a little bit more about him. So he's either invest directly personally through his kind of PE fund, NGG, or he also do through Kima Ventures. But then you see the sovereign wealth funds, BPI France. So in France, it's kind of a joke is you always get money directly or indirectly from them, because they will do venture debt, they will do direct investment, they're going to be LPs in funds. They offer like so much different financing way that almost every startup in one way or other will get money from them. So that is always happening there. I'm sorry for the red, it was sharp, but we got an issue with the slide. But here you get also, even if some Korean or Japanese company investing in those French companies, you get, of course, the French one. So here is like 2 funds. The KM is Kylian Mbappe, who invested personally into Sora. And then you get, of course, some American organization investing there. But the branding also help a lot to get more visibility and get more access for those companies. So as I mentioned, the French tech is having hub across the world. So you have like 64 communities across the world. And one of them is, of course, Tokyo, which I recall correctly is operated as a Slack here, not a WhatsApp, but quite often is WhatsApp or sometimes even Facebook group. So that is also a way to connect for people across the world. I mentioned I will talk about Xavier Niel. Does anyone know 42? Okay, maybe we don't have enough developers here. We only have the investors. So 42 is a coding school that done very differently, where you don't have professors, it's peer learning and you learn through the machine. So that is a school that he created and then now expanded in 30 or 40 different locations. And after that, he also have created something called Station F that people may go in France, may know about it, is the arts of the early stage startup ecosystem in Paris, so therefore in France. And he also provide accommodation with something called Flatmates and Kima Ventures, which is his fund. So with Kima, he does around 100 investment per year. Interestingly, only first check, no follow-on. And they roughly, for all of them, do 100K euro. So that's Xavier Niel, is a French billionaire. And as we can see, sometimes you have some individuals that can have as big impact as some government. So when you look at Station F, it's very interesting because it's a massive building. That is a 250 million budget to launch that, but they split it across different ways. So you have the share zone, the create zone, and the chill zone. So you can see like the create zone is like more quiet, more restricted area, and is where startup are big builds. The share zone is more like an event space, and the chill zone is more like the restaurant. So they have like different level of interaction across the space and different level of access. But that is very interesting to look at how people can exchange and join that space. They host, in fact, a lot of corporates and government program there. They don't want to be described as a co-working space, but you can see a lot of top brands like from Facebook to Naver, to LVMH, having their own accelerator for startups. And interestingly, we also get some other people who are doing quite a bit across the ecosystem. So here also, interestingly, we go back to a billionaire about doing a lot across the ecosystem at different stages. So again, for Station F, there were rumors, there were maybe some tax break from the government. That could be also sometime interesting to see how government can partner with those individuals that are already very active across the whole startup ecosystem. So let's look at Singapore. Maybe some of you may know about Temasek, very well known for their amazing investment in FTX, if I recall correctly. They have to fire a few people and punish a few people for that. But I mean, in a way, if that never happened, maybe they don't take enough risk. But when you have the money as a sovereign wealth fund is a bit more challenging. So those are like mostly Singaporean-based company when they have majority investment. For some of them is 100% investment. So they're very focused on those businesses. But they also have minority investment in companies that are based across Southeast Asia, but also Europe or China. Interestingly about Temasek is they have a lot of other subsidiaries. Here, I didn't list all of them, but you have a few. 65 equity partner is very interesting because their goal is to invest in a company at a later stage, like Series C, D, and then help them to go for the IPO. If you look at Innoven or Evolution Debt Capital, that is venture debt. One, they partner with UOB. The other one, they partner with DBS. But remember, DBS is a company they have also quite a big of shareholding. So as that they're working with themselves. Here you get some other interesting one. I will just mention two. Menalia is a very interesting one because that is a venture building. So I was like, wait a minute, like a sovereign wealth fund with hundreds of billions under management is building company from scratch. How long that is going to take to have an impact for them? But they're trying that. So that is kind of something quite new there. And Vertex, we're going to cover a little bit more about it. But interestingly, they have been also investing in a bunch of venture funds that are mostly focused. I mean, those ones are focused Southeast Asia. My guess is small check. And what they bring to them is mostly branding. If you're a fund and you can say that the sovereign wealth fund is your LP, that definitely helped to open a lot of doors. So BPI do that as a next level stage. I think it's 500-600 funds that are LPs. Temasek is very selected, very small group of funds that are supporting across the ecosystem. But as you can see here, a few, they didn't have done fund one. They have done fund two, fund three, fund four. Because for two reasons, most of those fund one were 10 million or sub 10 million. It was the early days of the Singaporean startup ecosystem. Second, they were already supported by another program by NRF, when it was a matching program close to the Yozam program in Israel they get inspired for. So that program as a government is interesting because they get close to a dozen of VC funds. Today, only 3 of them have survived. So is most of them a failure? But it's kind of, as Mark mentioned, you do 40 deals, you get 6 bringing the return. They've done a dozen, they get 3 kind of bringing the return for them. So government also need to be comfortable with taking risk and absorbing that failure, which could be sometimes quite difficult for government and entities. So I'll go a little bit deeper into Vertex. They started in 1988, and it was part of ST Engineering. So it was more a CVC. But if you remember, ST is owned by Temasek. So then they changed kind of who is the owner, and they moved it to Temasek in 2008. But here, what I don't mention, they also have a program called Technopreneurship Fund. So if you go in Singapore, don't mention that to any government official. They have very bad memories about that fund. It was $1 billion fund. And the focus was to bring mostly US investors to set up shop in Singapore. I think they barely managed to deploy half of it, and none of the US investors moved to Singapore. It still bring back money, so it wasn't bad in terms of financial, but the main objective was to bring those people to Singapore, and that didn't happen, so it's kind of a difficult stories for them there. And then from being a fund, Vertex become these massive beasts. So that is public information. I'm not disclosing anything private here. But they had like a lot, they decided to have a lot of funds across geographies. They also have founder funds, as well as vertical fund like healthcare or growth stage funds. So that is, they build like that big fund, and they also started to be more and more independent outside of Temasek. So they started to have external LPs to back Vertex. So it's still considered as a very linked to Temasek, but it's getting less and less dependent of Temasek. I mentioned about space, and it's very important for people to meet. So here, if you can see the blue building, it was the first building of that initiative. It was supposed to be completely teared down, but they decided to save it, which was from GTC, which is a real estate arm of the government, and Singtel, which is a company that is also where Temasek have a lot of money there. And then they decided now to have around 6 or 7 buildings. So it's a mix of building they save from destruction. So it's like industrial building, and some building that they build brand new. Like you can see the yellow one on the front part of the picture is a brand new one. So they build that density of startups. So it's end up to be a little bit like Station F in France. If you want to see early stage startup, you are going to end up to spend time here. So they have also some food option there. They have also those kind of directories for you when you are there to see which startup are there. They also have some sports facilities as well as event facilities there. So they build that kind of hub. And interestingly, what you can see here is INSEAD is just in front of it, the school created by George Dorio, and NUS, which is the top school in Singapore, and I think maybe not top 15 in Asia. They're also just behind, but it's a massive campus, like an American campus. So it's not that easy to connect between the two, but they're very close. And NUS will also have its own facilities inside those buildings and their own community. In fact, they launched something called Block 71 across the world. So you have one in San Francisco, you have one in Indonesia, you have in China. So you can find also that network of Singaporean across the world. And often they will end up to cluster around that space in those cities. Another billionaire, interestingly, it seems is that what I found is mostly 40 years old male billionaire. I'm looking at the woman. So if you have any suggestion, I'm very open. But here, what is interesting is you may have heard about this downtown project that Tony was working on, and he looked a lot about collision, also about how people meet. And interestingly, he's also having a portfolio of projects. So some of them are DTP, which is downtown project. It was Life is Beautiful, which is more about running events. VTF Capital, which is an investment vehicle, or Nine Bridge School, which is about doing education. So interestingly, when you look at those few billionaires, they look at a lot of different verticals. Some of them also go into the media and all the things, but when you look, there's quite a deep connection around like the entrepreneurship there. So a few interesting initiatives to look after. So I mentioned in the beginning, the visa. I think Shock is going to agree with me. That is the best flag ever we can see, right? So that is Malaysia flag. So interestingly, Malaysia offer a very generous visa. They offer 5 years visa for entrepreneur for the experimented one. If you are fresh new is 1 year, but when you renew, you get 5. So interestingly, they commit to you where some other government commit less. So France offer you 4 years. Interestingly, those two countries will also offer roughly the same length for the investor visa. And then you will get UK will offer you like 3 years, and then Singapore. So Singapore is very transactional. They offer you 1 year. And then when you renew, 1 year. And then you renew, 2 years. Where interestingly, if you are working as an employee, as a foreigner in Singapore, usually your first visa is 2 years, and then you can go into a 3-year visa. So Singapore is, okay, you can be entrepreneur, but please show me result in 1 year, because everyone know in 1 year you can do so much as an entrepreneur. I'm joking a little bit. They don't ask you much to renew it, but still they only give you 1 year. And what people may don't know, if you're not working as a foreigner, in Singapore, the last 6 months, you cannot open a new bank account. You cannot sign a new lease. So it's kind of, you just have 6 months of freedom as a visa. And then you have 6 months as kind of probation until you get your next one of 1 year, right? So that is something I think a lot of governments should think about, is those people that move to your country to build a business, they're not showing the easiest path, is very challenging compared to being an employee. But at the same time, they already have a massive challenge in terms of cash runway. Please don't add a visa runway for them to know how many more months they can stay in the country. I think that is way too much trouble. Government should offer a little bit longer, especially places that are quite expensive to live. If you're in Singapore, trust me, even if they give you 5 years, it can be very costly to live there. So if your business is not going well, you may move elsewhere. It will be very challenging to stay there for a very long time. Something that I think quite interestingly on public market, which is also a way to offer quite a liquidity. So here you get the Singapore public market or the Indonesian public market. You get those two gentlemen who get appointed quite recently. So Kubunwi is a self-made man, who has been on the board of almost every Singapore-owned company, from Singtel to DBS to Singapore Airlines. But just recently, he got appointed as a chairman of the stock exchange. What people may don't know, you may expect Singapore to be the leading stock exchange in Southeast Asia. In fact, they're behind Thailand, interestingly. So that is quite challenging for them there. And then Indonesia is the one also pushing very hard. Is still an option for a lot of Indonesian companies to be listed there. But what is interesting is those two gentlemen, they also are founding GPs of VC funds. And they end up to be on the board of a public listed of the public listing thing. And Kubunwi is also having his family office, which is called Black Kite. And through that, he do angel investment. He's also LPs in funds. So it's very interesting to see his profile to be as a chairman of the stock exchange and going to know very well about private market. And Pendu is doing NDS Capital too, which is a secondary fund. So he also knows a lot about secondaries, and he comes also from a pretty good family in Indonesia. So it's quite interesting to see all those connections. And interestingly, those two men roughly same time happen to be on the board of the stock exchange. So I'm wondering to see if we're going to see that more often in more other place to connect a little bit more private and public markets. Conferences are always being something to connect people. And some good startup being built from there. I think Uber was built because Paris sucks as getting taxis. So those guys have to build something. So some ecosystem have started way before. So you look at Dubai with GTEx have been there for a very long time. Then you start to get Saudi was like, hey, we should have our own events. So they pay some people from Informa to do Leap, which also the people who do super return for people attending such event. And then just now you get Doha, who decided also to pay Web Summit to get their own event there. Interestingly, that could be quite costly. So that is a public figure, and that is how much Lisbon, the city, is paying for a 10 years contract to bring a lot of people into their ecosystem and also to really support the touristic part of it. Interestingly, they do it in November. So when there's not much people in Portugal, so you can really absorb, but you can also really offer like a 1 week of a lot of business for all those organizations there. Lastly, back to Malaysia, corporate could be also part of it. So here is like a tax incentive system offered by the Malaysian government to support corporate to set up their VC arm. So that is also a way to externalize that. It's not only about the VC, but corporate can also play a role. And often corporate are not very loved in the startup ecosystem, but I think people should remember that most of M&A come from corporates. Corporate are LPs in many funds. I think on Dave's slide, a lot of LPs in Japan were corporates. And they're also the clients of most of your B2B startups. So corporate really play an important role in any startup ecosystem. So to finish, a few things we would like to see more. So fund of fund to focus on emerging fund manager, especially people raising fund 1, fund 2. There's very few people willing to make those bets. So government should support that. Also difficult to find the fund of fund to do only that. So it's also a question of how do you incentivize people to go there? After that, debt fund, also very important later on the ecosystem. So that is something also usually is quite difficult to raise when you're among the first few. And secondary fund will come after because you need to provide liquidity to the first two. So that is also something very important. And we don't see much support from government for such initiatives. Interestingly, Canada was working on a fund. If you want to have fund of fund, you need to go a little bit behind. So that is also a very interesting initiative because at one point, government should only come here to solve the bottleneck and then withdraw themselves and go to the next bottleneck. Of course, that is just an image. You have several bottlenecks to solve at the same time. So that is the role of the government to do all of them. And please give 5 years visa to entrepreneur. Don't give them just a 1 year to get their things done in a new country. So that's it for me. You can scan the QR code to connect on LinkedIn or send me an email if you have any question. Thank you.
Check. Can we just go back to the last slide that Arnaud was showing? I just wanted to highlight a few things here. So for everybody, we tend to use this shorthand of FOF. That stands for Fund of Funds. We're going to be talking a lot about that today. That's a VC, a fund that invests in other funds. And I haven't seen the fund of fund before too much, but that's an interesting abstraction. I think this point I want to just keep making, and I'm sure the Japanese government has also got several topics we're going to discuss later today on this. We'll have a session specifically at 3 p.m. on fund of funds in the US that invest in emerging managers. I can't emphasize enough how important this is. And for the Japanese folks in the audience, please don't use your fund of funds to invest in established VC funds. They don't need the money. You need to invest in emerging managers who are on their fund 1s and 2s, even if they might fail. Yes, I'm going to raise my voice. I know you're telling me to lower my voice. The translators in the back are like blowing their ears out, but I'm trying to make sure that we make this point. Some of you may have seen a talk that I did 10 years ago in Osaka where I was banging the gavel with my shoe, I think, Khrushchev style.
On that one, maybe a good example we can mention in the US will be Sendana. So Michael Kim and his team.
We have a bunch, and
okay.
We'll talk about that later today. But Sendana also even Sundana actually invests in probably fund threes, not as much fund ones and twos.
I've done some fund one, fund two in South
yes,
Asian
they have a nano fund, absolutely. But I want to emphasize all the things that Arnaud had mentioned here are critical for the ecosystem, and even venture debt and secondary fund structures are very important. But the one I really want to make sure is, in order to get your ecosystem started, you need lots of startups. Big VC firms generally are not investing in early stage startups. They're investing in later stage companies that are already successful. And they will complain and moan about, oh, there's not enough talent to invest in, not enough great companies. And yeah. How do you get those great companies? You invest in lots of little shitty companies, 3% of which go public 10 years later. Who invests in those shitty little companies? Emerging managers and seed funds. Who invests in those seed funds? Fund of funds. So I will emphasize that point, and I'll use this cane to this is great. I really don't need this thing. I just use the cane for sympathy and to make you think that I'm important. But we'll keep coming back to this topic. I know we're running a little bit over.
I mean, that is also simplification. Like a lot of those first-time fund manager will raise a lot from corporate, will raise a lot from people like Russells. So you also need to have the right tax incentive aligned for those people and allow them to invest. So they are never going to raise all the money from fund of fund, but the advantage of the fund of fund is usually they will commit for 2 or 3 funds. So that is better quality money for GP. So it's why here we focus on that one. But there's a lot of other type of investors joining those funds.
And something that Arnaud mentioned that I also want to emphasize is venture capital in the US and in many other countries was initially subsidized by government, heavily subsidized by government, starting in the 60s in the US through the SBA program and the SSBIC programs. Even Bill Draper and Tim Draper started their very first fund using matching funds coming from the US government and the SSBIC funds. And Arnaud's point before about this did not happen overnight. The US venture capital ecosystem has been in development for 70 or 80 years. The first 30 or 40 years of that was heavily subsidized by the US military and the US government. It did not happen magically private capital out of nowhere. It happened because the government made a huge investment in venture capital and innovation and research, initially through the military and then later through academic institutions.
And I think another gentleman, I think I was enough men on my slides, but another one that play a big impact in the US will be David Svensson from Yale. So he ended up to invest a lot on venture capital. I think it was close to 20% of the endowment fund, but also endowment fund, especially from school, have a lot of tax break. So that is another thing that also support a lot the ecosystem in the US. And you don't have much endowment fund in other countries. It depends also of the retirement system.
And also in the US in the 1970s, something that was called the prudent man rule changed, which allowed US mutual funds to invest in venture capital funds. That was actually an explosion of venture capital that funded Kleiner, Perkins, and Sequoia, and several of those others. Even though they might have started around that time, they raised a ton of capital that came because of that change in the law that allowed mutual funds in the US. Okay, we've been nerding out a lot on this. We have one more speaker before our break. My partner, Aman Verjee, who wears a big cowboy hat, although he doesn't live in Texas. And he's going to give us a little picture on global macro, and then we'll take a break. We're, again, running a little bit behind. We'll catch up at the next break. Thanks.
Okay, thank you. Thank you. That was great. I especially appreciate the gavel banging, the shoe banging image of Dave looking like Khrushchev, but making his point very clearly as always. By way of introduction, let me just give you a little plug for the venture firm that Dave and I run along with Stephanie Shorter. We run a firm called Practical Venture Capital. Let me start where Mark ended on the secondary market. And he gave you a bit of a framework for how it works. Employees and early LPs invest in companies. They invest at lower valuations, or they exercise shares and buy stock at lower valuations. Those get marked up. Eventually, those folks need money to pay bills, to pay taxes, to buy houses, to send kids to school. That's kind of the theoretical framework. Let me make it more practical. This is how a venture capital firm works in real life. The first 5 years of a venture capital firm, as many of you know, are a bit of a mess. You invest in a lot of companies. A lot of the losers get written off in those first 2, 3, 5 years. You pull fees and management fees out of the fund, so that's front-loaded. Around the 5-year point, something good starts to happen. Your winners begin to emerge, right? They get marked up and that becomes the majority of your NAV. The values continue to grow at the rates that those Series B, Series C, Series D's winners that they get to. And around that 5 to 7 year mark, a lot of these LPs and early employees also need liquidity. So as a secondary firm, we step in, we buy those shares in a normal market, 20% discount, 25, 30% discount to where they're being carried. In a market like today, like Mark talked about, we're seeing 50, 60, 70% discounts to fair value. And so we jump into the midpoint of the fund, we ride the beta. When the IRRs are accelerating, we skip the J curve. So we get the beta of the venture category. We get alpha, normal market, 20% discount. This market, more like 50% discounts. And it's a shorter term for liquidity. So that's just a quick plug for our firm. Let me pull back for a second. And what I want to talk about today is the public markets and where we are in the cycle. And let me remind you that venture capital is a tiny little piece of flotsam bouncing around in a giant ocean of money. Okay. And knowing what that ocean is doing and why and what's creating those waves and those cycles is really important to navigating where we are in this current business cycle. I've listed a bunch of bubbles that have been created over the last 400 years. I actually remember, I think one of them, the subprime bubble back in 2008, what Mark referred to as the Great Financial Crisis, triggered in the US, but happened in a few other countries around the world. It was started by a subprime bubble in 2008. I was actually alive and I remember that. So I'm probably in my 40s, as you can tell. I don't really, I kind of sort of remember the 2000 .com bubble. I was working at PayPal with Dave at that time. I was like a junior itty bitty finance guy at the time. Probably too young and too stupid to really understand what that meant, but I do remember how it played out. But I read history. And so I know that those two events are not the only financial bubbles that have been created. Many of you will recognize or remember the Japan bubble, which happened between about 1984 and 1990. And I've researched bubbles going back to in the 1600s, just to understand how these cycles play out over what time frame, why, what causes bubbles, what do they have in common, what do you do when you're in them, and how they play out. So I actually teach this topic at Harvard Business School now. I'm working on a book which will hopefully be published sometime next year, which you can read. But let me give you the quick synopsis of it. So there are a number of things that governments do which kind of create these bubble conditions. There's probably 9 of them. In the Japan one, you might remember, does anyone remember the Plaza Accord, 1984, 85? Are any of you old enough to remember that? You guys all look very, very young in the audience. But if you read history, we got one hand in the front. If you read history, you'll remember there was like currency manipulation and lower interest rates and things that drove capital flows that created that bubble conditions. There's really 2 big ones, 2 big things that governments do to create these types of bubbles. Fiscal stimulus on the left, monetary policy on the right. Mark alluded to some of this. The left-hand side is basically what happens. It's the federal deficit as a percent of GDP. Those red bars are basically recessions going back to World War II. You can see the lower that line goes, the bigger the deficit created by the government. In 2020-21, the US government, followed by Europe, and to some extent Japan, created deficits that had never been seen before in modern history. You got to go back to World War II to find those deficits. Okay, at the same time, on the right-hand side, the Federal Reserve in the US, followed by the ECB in Europe, Bank of Japan, Bank of China, they did something that had never been done before, except once during the last recession, but this time they did it on overdrive, on steroids. They went and bought government securities and bonds, and they created and printed money. The combination of those 2 things creates an easing of financial conditions. You can measure it in a lot of different ways. I like just a simple growth rate in the money supply. This is the US. This is what the money supply did in the US. For years and years and years and years, the money supply was growing by 5, 6, 7% a year. Beginning around March of 2020, that growth rate jumped to 25% year over year and was held there for 2 years. So for 2 years, they were like growing the money supply at about 20 points over trend. That means they created 40% of extra money. Where did that money go? It spilled into the financial markets. First the bond market, then the commodities market, then the public equities market, housing, Bitcoin, baseball cards, any asset you can think of, crypto, right? Anything you can think of began to show these types of bubble-like conditions, just like we've seen throughout history. And tech and the private sector was no different. We were caught by that as well. The money supply has now begun to shrink. This is the first time in the history of the United States that money supply has been shrinking for over a year. I take that back. There's one time when it happened, 1933. That was the last time that the money supply was shrinking in the US. And if you read history, you know that 1933 didn't turn out too well for the economy globally or locally at the time. So we are still in the shrinking money supply conditions. So we are still in a very challenging, tough set of financial conditions. So how have all these markets reacted? I'll go through a couple of these markets just to show how they've risen and fallen during this period. This is a US bond index. They were kind of phase one of the bubble. The blue line shows as soon as that money supply flood started, bond prices shot up. They stayed elevated for about 2 years. They began to go down in Q1 of 2022 when the tightening happened. Okay, that's the bond market. Next was the commodities market. Similar pattern for years and years and years and years. We'd been in a declining, a commodity super cycle where prices were declining. Right around Q1 2020, Q2 2020, they began to go up. They went up for 2 years, and now they are back to declining. On and on and on, we can go through all these asset bubbles. The top chart is US housing prices. You can see how for years it was pretty steady. It shot up during the bubble. It started to come back down, but nowhere near normalized, right? That line on the top right doesn't seem to be still back to that prior trend. So there's still potentially a lot of room to grow. Bitcoin, same thing. Market after market after market. Now, this is a similar slide to what Mark was showing. What's the private sector done? What are the public stocks done? And how does that implicate the venture capital industry? This is an index we track, a SaaS index of 105 companies in the US. Going back about the last 10, 15 years, the average multiple, sales multiple, was like 7x, 8x, 7x, 8x. It got as high as 17 during the peak, and we're right back down to 7 now. So this part of the market has kind of normalized. We're back to that 5-year, 10-year trend. I think that's pretty good. Now, the good news is the SaaS category continues to grow, right? We've had lots of growth. They're more profitable now than they were 5 years ago. Their TAMs are bigger. The opportunities are bigger. Arguably, the technology is better, right? The software technology we're seeing and the advances in AI and other fields is better now than it was 5 or 10 years ago. There's also more money in the space, so we're better capitalized. But the multiples have gone right back to where they were for that 5 or 10-year average. So if you're a long-term buyer and you're thinking about investing in tech generally, in retrospect, it would have been great to have avoided the big bubble when everything was expensive to historical average. We're right at or below historical average now. So that would suggest that we're back into a favorable buying market. Where are we on the venture curve? Now, this is the really interesting part for venture investors. This is a line showing average round sizes for Series A companies in the US. The red is like a stock market correction when the market goes down by 20% or more. And that's happened. It's happened actually 5 times going back to 2013. So what does that line normally do during a market correction? It usually kind of goes flat, but doesn't move around a lot, right? It kind of cruises through those red spots. There's a little bit of a decline, a little bit of a lag, but usually Series A valuations are pretty robust. They took off during 2021 and they're down 24% since the peak. So that's a modest correction, a reasonable correction. Still doesn't feel like these are cheap valuations. In fact, we're still way above where we were in 2020, 2019, 2018. Still feels fairly expensive. So to me, if you're investing in early seed stage Series A in the US, still an expensive market. But now look at the later stage market, Series D and beyond. These things have come down by 60% as the stock market has dragged it down. Very, very high correlation, almost a 1-for-1 drop with the overall public tech index, probably actually overcorrected versus the tech index now. 60% decline from top to bottom, cheaper than they were back in 2019 in absolute valuations and round sizes. So if you're going to invest, this would seem to be the place to go shopping, especially if you can pay like 2018 prices for companies that are now in 2023 with the progress, with the growth, and with the profitability. That's a much better deal. This part of the market seems to have fully corrected. So that's where I think we are in the cycle for venture. The good news is everything's on sale, and you can get those 60% discounts if you know what to look for and how to underwrite. The IPO market still very, very shaky. This is just IPO activity over the past few years. Back in 2019 and prior, we were seeing 50 billion in annual proceeds from IPOs. It got up to 150 billion in 2021 and then kind of went to zero. So we've had a year and a half with really no substantial IPO activity for tech-backed companies. We've only recently had 3, maybe 4 IPOs try to crack the market. 2 weeks ago, 3 weeks ago, we had 3 major VC-backed companies attempt to go into this difficult market. And we talked about financial conditions being tight and money supply shrinking. That's ordinarily a really tough time to go public. ARM, which is a semiconductor company backed by SoftBank, they made it out, but are now below their stock price, their initial stock price. We saw Instacart attempt an IPO, healthy business, growing, profitable, priced at a valuation that was about $10 billion. They had done a private round at $40 billion. So they were pricing way down from the last price round. They're also now below their IPO price. The only one that's done reasonably well is Klaviyo. And Klaviyo is a SaaS company. They're in the marketing tech space, very embedded in the Shopify ecosystem, growing phenomenally well. 650 million ARR, growing at 70% year over year in the last 12 months, projecting 50% growth, profitable, which you don't often see. And they did fine. They're the only ones that have done well, which suggests that's the sector. SaaS companies with robust businesses probably have the best shot for breaking this IPO logjam. But the metrics better be great. And so the ones that might be next in line would be folks like that, like Canva or Databricks. If you're a consumer company or in the marketplace space, that's very challenging. One thing all these companies are struggling with is declining growth. During the heyday in 2021, there was a lot of money coming into the space. They were all using that money on marketing, right? Those companies were growing. Their customers were growing. Well, now their customers are sharpening their pencils. They're cutting back on their workforce. They're tightening up on their spend. And all of a sudden, the growth rates in the public company SaaS index we've seen have dropped from 30% plus to low 20s. So there's a significant, it's challenging to go public when you have these kinds of growth rates, but that's what the sector is focused on right now. So last slide. So how do we think about and what do we advise founders and investors? If you're going to raise in this market, it's possible, but given the dynamics we talked about and the fact there's still some room to go on the IPO side, the IPO market is looking better than it was 6 months ago, but certainly not out of the woods. Your company better be awesome on these key metrics. If you're a SaaS company, you'll be valued based on growth and net retention, your unit profitability, and the growth rates you want to be able to show here are like 3x year over year, gross margins that are best in class, your LTV to CAC and marketing efficiency better be really, really buttoned up. And if you're losing money, that's okay, but the amount of losses or your burn should be less than your net new ARR. So we define that as a burn multiple, which we look at and we advise companies on, and we'll coach them on how to get the burn multiple to a point where it's under 1x. If you don't have those awesome metrics, it could be very difficult to raise at any valuation if you do raise at all, but it can get done. On the right-hand side are the challenging metrics. If your metrics are in that category, your growth rate doesn't look great, you haven't gotten unit profitability figured out, your net retention is barely 100%, your LTV to CAC isn't figured out, you're not going to be able to raise in this environment right now. So best thing is work. So cut your burn, manage your business, get your metrics to the point where you're into the very good or awesome category. So fix the business that investors will be thinking about. And that's probably the time to raise. So the advice to founders is move from right to left. And that's when you brave the market, because it seems like there's still going to be another 6 months, another 12 months, another 18 months of tough financial conditions. So investors are going to be gun shy until they begin to see this really turn. Okay, that is all I had. Thank you, Dave.
I should mention that Aman went to some very overpriced schools named Stanford and Harvard. And the presentation you're seeing here is really cheap because Harvard students pay $100,000 a year to get the course that Aman is teaching. You got it for $50, I think. So consider yourselves fortunate. And now you can put Harvard grad executive education on all of your LinkedIn profiles. We're going to take a break for about 15 minutes. We're running about probably 15 minutes, maybe 30 minutes behind schedule. We're going to try and get back on schedule. Let's take a 15-minute break. We'll come back. Victor Mulas will be speaking at 11:15. Thank you, guys.